This is kind of where we are in the markets, that we're hanging on every word by the Fed. And I think that alone kind of says something about where we are, that the hopium, of the Fed is what's going to keep stocks going up or down. What are your thoughts?
Well, I think that, Powell has been relatively pragmatic over the last little while, which I think has been right. I think the market has gotten extremely hawkish on the Federal Reserve. We knew what these inflation numbers were going to be. This wasn't a surprise that they were going to be high and strong. And you've had tremendous consumer demand for goods, driven by 3 rounds of stimulus checks, debt forbearance, increased credits from the government. So for 2 years, you've been heavily stimulating the consumer. You've run into supply chain issues. And so the persistence of inflation, or how high it actually is really an unknown. Federal Reserve policy hasn't led to this inflation. Central banks around the world have been pursuing the same monetary policy since the global financial crisis, which has led to low growth and low interest rates. So this has a lot more to do with what fiscal policy was. And as those things run off, and as demand begins to taper, what's the sustainability of 45% year over year price increases on used cars? So I think that what they're saying today is important for pragmatism, but I think financial conditions remain accommodative so far. The yield curve is flattening dramatically, and spreads are beginning to widen, especially after bullish comments. So, the Federal Reserve they do need to be careful. Their words can translate into major market impacts. But I think the pragmatism of the chair is certainly appreciated, and we'll have to see how the year goes. But 2-year interest rates are back to where they were in the summer of 19. 10-year yields are back to where they were in the summer of 19. And a whole host of growth stocks are back at multiples of 2017 and 18. So a lot of the multiples have now compressed, and interest rates are back where they were.
And no, I know we're fixated on the Fed and interest rates because they affect so many things like mortgages and things that people that don't even invest in the market have to deal with. But from a stock perspective, what's more important, rate hikes or the unwinding of the balance sheet?
Well, we haven't really unwound the balance sheet to any large extent, so we don't know what the overall impact of that will be. We don't know what the term premium will be once they start selling off bonds in large quantities or letting them expire. So you're asking for a question where there's just not enough data. And I think that's why they're leaning significantly more toward rate hikes than they are to QT right now, because, first of all, doing both at the same time, you won't be able to try and isolate the impact of one over the other. And we really don't know what the overall impact of quantitative tightening will be. So doing it at the same time seems reckless to me, and it doesn't seem to be what their preferred method is. It seems to be rate hike first, pause the obviously ending QE, and then QT not until a discussion until much later in this year. So we don't know, but we're certainly seeing spreads widening more recently, money leaving high yield for sure. Having said that, though, financial conditions aren't tight as of yet, and the economy and the consumer balance sheet and corporate balance sheets remain strong. So this is a very difficult needle to thread right here.